Mapletree Industrial Trust, or MIT, is a major player in Singapore's data center and industrial space, with assets across high-spec factories, business parks, high-tech buildings, and a growing data center portfolio in Singapore, North America, and Japan. Once trading near its peak of 3 Singapore dollars and 25 cents in 2020, MIT has since pulled back to around 1 Singapore dollar and 99 cents as of August 2025. But in today's climate of high interest rates and economic caution, is MIT still a source of stable income and resilience, or has its growth slowed? In this video, we'll break down MIT's dividend strength, portfolio mix, valuation metrics, and analyst outlook to help you decide if it still earns a place in your portfolio. Mapletree Industrial Trust unit price has seen sharp declines year to date. In early 2025, JP Morgan downgraded it from overweight to underweight, cutting the price target from 2 Singapore dollars and 50 cents to 1 Singapore dollar and 90 cents. The downgrade cites rising vacancies in older U.S. and Singapore data centers, potentially impacting 5 to 6% of revenue and driving projected 4% annual DPU decline over the next 2 years. Occupancy is also slipping, down from 92.1% to 91.6%, especially in North America, raising concerns over lease renewals and further downside. Mapletree Industrial Trust, or MIT, is one of Singapore's top industrial REITs, blending high-spec industrial assets with a growing global data center presence. Valued at 9 billion Singapore dollars, MIT owns 83 properties in Singapore, 55 in North America, and 2 in Japan. Its diverse portfolio includes data centers, high-tech buildings, business parks, flatted factories, and light industrial spaces. MIT focuses on sustainable returns through active asset management, strategic investments, and a prudent capital structure backed by strong ESG practices. Recent moves. In October 2024, it acquired a West Tokyo site, $130M, with data center potential. In May 2025, it sold a U.S. data center at an 18.6% premium to fund growth. Occupancy averages 92.1% with positive rental reversions. ESG efforts include solar panels, EV charging, and green building certifications. As at March 31st, 2025, Mapletree Industrial Trust portfolio is worth about 9.1 billion Singapore dollars, split across 6 distinct property segments. Data centers dominate at 55.6% of total assets, reflecting MIT's strategic pivot toward digital infrastructure. These include hyperscale facilities in North America, Japan, and Singapore. The next largest category, high-tech buildings, makes up 16.7%, catering to technology, R&D, and light manufacturing tenants. Flatted factories contribute 15.4%, offering cost-effective multi-tenanted space for SMEs. Business park buildings and stack-up or ramp-up buildings each account for 5.8%, serving modern logistics and corporate campuses. Finally, light industrial buildings form a small 0.7% slice, mainly legacy assets. This breakdown underscores MIT's balanced approach, combining stable industrial cash flows with high growth, future-proof data center investments. Geographically, MIT maintains a well-diversified footprint. Singapore remains the single largest market at 47.6% of assets, with 83 properties forming the trust's operational backbone. North America is close behind at 45.6%, comprising 56 properties, almost entirely data centers. Japan accounts for 6.8%, with 2 properties strategically located to capture Asia-Pacific data demand, a key earnings driver. This near-equal split between Singapore and North America gives MIT both domestic stability and international growth, while the Japan exposure adds a new layer of diversification. Let's break down Mapletree Industrial Trust FI 2025 distribution per unit, or DPU, contribution across its portfolio. Looking at the first chart, business segment contribution, high-tech buildings take the lead, delivering around 4.85 cents per unit, making them the single largest DPU driver. Close behind, data centers contribute about 4.37 cents, underscoring their growing importance in MIT's income mix. Business parks add roughly 1.71 cents, while flatted factories bring in 1.57 cents. Light industrial properties contribute a modest 0.94 cents, and others round out the portfolio with about 0.56 cents. This mix shows MIT's strength in high-spec and digital infrastructure assets, which provide both stability and growth potential. Now, shifting to the second chart, regional contribution, Singapore remains the anchor market, contributing approximately 8.54 cents per unit, or more than half of total distributions. North America follows with about 4.99 cents, reflecting MIT's strategic push into overseas data center assets. Japan, the newest market in the portfolio, adds 0.47 cents, with contributions expected to grow as recent acquisitions in Tokyo and Osaka ramp up. Together, these charts highlight how MIT's diversified asset base, both by business segment and geography, support a resilient and sustainable income stream for unit holders, even in a high-interest rate environment. As of March 31st, 2025, Singapore remains the single largest contributor to Mapletree Industrial Trust's asset base, making up 47.6% of total AUM, valued at 4.34 billion Singapore dollars. The portfolio is spread across 6 property categories. High-tech buildings lead the way, contributing 35% of Singapore's valuation, or about 1.52 billion Singapore dollars. These 15 properties house 331 tenants, generating 179.2 million Singapore dollars in gross revenue, with a healthy occupancy of 92.8%. Flatted factories are the next largest, at 31.7% or 1.38 billion Singapore dollars, across 40 properties. They have the highest tenant count, 1,268, and maintain a strong occupancy of 93.3%. Business park buildings account for 12.2% or 529 million Singapore dollars, but show a lower occupancy of 85.6%, indicating potential for rental recovery. Stack-up and ramp-up buildings contribute 12.1% or 525 million Singapore dollars, with only 5 properties but a high occupancy of 97.7%, reflecting strong demand for these logistics-friendly spaces. Light industrial buildings make up just 1.4% of the Singapore portfolio, valued at 62 million Singapore dollars, while data centers form 7.6%, worth 330 million Singapore dollars, with a perfect 100% occupancy, underscoring the mission-critical nature of these facilities. In total, the Singapore portfolio comprises 66 properties, generating 546.1 million Singapore dollars in gross revenue, housing 1,737 tenants, and maintaining an overall occupancy rate of 93.1%. This balanced mix across asset types and tenant industries provides MIT with both stability and room for growth within its home market. As of March 31st, 2025, North America accounts for a significant 47.4% of Mapletree Industrial Trust's total assets under management, almost equal in scale to its Singapore portfolio, with a combined valuation of 4.0 billion Singapore dollars. The portfolio here is highly focused on mission-critical assets, with data centers dominating the mix. They represent 86.3% of the North America valuation, or 3.45 billion Singapore dollars, spread across 33 properties. These facilities host 110 tenants, generate 450.2 million Singapore dollars in gross revenue, and boast a near full occupancy rate of 98.5%. With a total net lettable area of over 320,000 square meters, these data centers are strategically positioned to serve cloud providers, hyperscalers, and enterprise clients, anchoring MIT's recurring income base. The second largest category is high-tech buildings, making up 12.5% of the regional portfolio, or 500 million Singapore dollars in valuation. Comprising just 4 properties, these assets bring in 55 million Singapore dollars in gross revenue, with an occupancy rate of 94% and a net lettable area of 55,000 square meters. They cater to tenants requiring advanced infrastructure for R&D, light manufacturing, and technology operations. Business park buildings form the smallest segment, at 1.2% of the regional valuation, or 50 million Singapore dollars. The single asset in this category serves 5 tenants, produces 6 million Singapore dollars in annual revenue, and maintains a 90% occupancy rate. In total, MIT's North American footprint spans 38 properties, delivering 511.2 million Singapore dollars in gross revenue. The region's asset mix, with its overwhelming tilt toward high-spec data centers, underscores MIT's strategy to position itself in resilient, technology-driven real estate segments with strong demand visibility. This concentration not only complements the more diversified Singapore portfolio, but also enhances MIT's long-term growth prospects by capitalizing on the global shift toward digitalization and cloud infrastructure. Mapletree Industrial Trust Japan portfolio is small but strategic, making up 6.8% of assets as of March 2025 with two data center properties. The first, Osaka Data Center, saw its final upgrades completed by May 2025 and is now fully operational, boosting income ahead. The second is a freehold facility in West Tokyo, acquired at a discount in October 2024, fully leased on a 5-year WALE to a Japanese conglomerate. Its prime location offers strong redevelopment potential in a high-demand, supply-tight data center cluster. Together, these assets diversify MIT's portfolio, secure stable income, and provide future growth opportunities. Mapletree Industrial Trust reported steady growth in its latest results. Revenue rose 2% to 684.9 million Singapore dollars, while net property income increased 2% to 531.5 million Singapore dollars. Distributable income climbed 3.5% to 388.1 million Singapore dollars, driving a 1% uplift in DPU to 13.57 cents. Net profit margin improved to 56.1% on strong cost control. Gearing rose slightly to 40.1% with a debt-to-equity ratio of 0.65. Despite a 10.3% decline in unit price to 2 Singapore dollars and 10 cents, trading volume surged 43% to 6.94 million units. Overall, MIT delivered resilient income growth and margins while managing higher borrowing costs and market volatility. Mapletree Industrial Trust valuation metrics from 2021 to 2024 show steady asset growth and moderating valuations. NAV per unit rose from $1.66 in 2021 to $1.86 in 2022, before easing to $1.76 in 2024. The price-to-book ratio fell from 1.65 times in 2021 to 1.28 in 2023, then improved slightly to 1.33 in 2024, while the price-to-NAV premium declined from 65% to 28% before rebounding to 33%. Dividend yield strengthened from 4.6% in 2021 to 5.7% by 2023 to 2024, appealing to income investors. Price to FFO also fell from 21.8 times to 17.4, signaling cheaper valuations. Overall, MIT has expanded its asset base, sustained attractive yields, and now trades at more moderate levels than in 2021. Let's look at Mapletree Industrial Trust's cash flow and debt coverage from 2021 to 2024. Funds from operations rose steadily from 325 million Singapore dollars in 2021 to about 356 million Singapore dollars in 2024, reflecting stable rental income and cost discipline. The interest coverage ratio, which shows how easily profits cover interest costs, was 5.4 times in 2021 and eased at a high 4 times range as rates rose. Still a strong buffer. Overall, MIT has sustained healthy cash flows and solid coverage, ensuring stable distributions even in a higher rate environment. Large and diversified tenant base. MIT has a large and well-diversified tenant base that underpins the stability of its portfolio. As at March 31st, 2025, there were 2,327 tenants with 3,349 leases across the overall portfolio. About 62.9% of these tenants, by gross rental income, were multinational companies, while the remaining 37.1% comprised small and medium-sized enterprises. Looking at the tenant diversification by trade sector, information and communications is the largest segment at 31.25%, followed by manufacturing at 27.19%, wholesale and retail trade at 15.14%, financial and business services at 14.51%, and other trade sectors at 11.91%. No single trade sector accounted for more than 17% of the portfolio's monthly gross rental income, helping to reduce concentration risk. On the right, we see the top 10 tenants, which together contribute 29.5% of monthly gross rental income. The largest single tenant, HP Singapore, accounts for 6%, followed by a global colocation provider at 5% and an established data center operator at 3.7%. No single tenant accounts for more than 6% of the portfolio's rental income, reinforcing MIT's resilience and stability. MIT's overall portfolio occupancy was 92.1%, slightly down from 92.6%. The Singapore portfolio remained the anchor at 93.2%, supported by rental growth from 2 Singapore dollars and 20 cents to 2 Singapore dollars and 27 cents PSF/MTH through positive reversions and new leases. By geography, Singapore was stable, while North America dipped from 90.3% to 89.3% due to non-renewals in Philadelphia and Tempe. Still, rents edged up from $2.44 to $2.47, with 71% of expiring leases renewed or relet, anchored by long WALE data centers. Japan stayed fully occupied at 100%. Within Singapore, data centers also held 100% occupancy. High-tech buildings were steady at 87.6%. Business parks dipped to 80.3%. While flatted factories and stack-up/ramp-up buildings remained strong near 98% and 97%. Light industrial buildings were lowest at 51.8% due to vacancy at 26 Woodlands Loop, a minor 0.7% of the portfolio. Overall, MIT's diversified base and proactive leasing continue to drive stable occupancy and rental growth despite localized headwinds. The manager remains focused on tenant retention and forward renewals to sustain occupancy. In FI 24/25, Singapore retention stood at 75.7%, with 36.4% of tenants staying over 10 years and 67.2% leasing for more than 4 years. Tenant longevity is strong. 24.4% have stayed 5 to 10 years, 18.2% for 10 to 15 years, and another 18.2% for over 15 years, providing stability and resilience. On lease structures, 73.9% of the data center portfolio is on triple net leases, 11.3% on double net or net, and 14.8% on gross leases, ensuring cost risks remain low. The data center mix is diversified across 58.2% powered shell, 22.6% fitted, and 19.2% hyperscale facilities, serving varied tenant needs. By tenant type, colocation providers contribute 45.9% of rental income, enterprises 26%, cloud and hyperscale providers 20.9%, and others 7.2%. Looking ahead, the manager aims to strengthen long-term leases with major cloud and colocation players to drive both growth and stability. From 2021 to 2024, Mapletree Industrial Trust maintained a prudent financing profile. Gearing rose from 34.2% in 2021 to about 40% by mid-2022 and stayed around 39.8% in mid-2024, well below the 50% cap. Cost of debt increased with rates, climbing from 2.3% in 2021 to 3.5% by mid-2024. To manage volatility, MIT kept most borrowings fixed, about 78% in 2022 to 2023, and 76% in mid-2024. Its debt maturity profile is also healthy, with an average term of 3.9 years and only 13 to 15% maturing between 2025 and 2026, reducing refinancing risk. Overall, MIT has balanced rising costs with moderate leverage, high hedging, and staggered maturities, ensuring stability in a higher rate environment. MIT shows resilience with moderate gearing. Rising borrowing costs may cap near-term income growth, but its diversified portfolio, disciplined management, and data center focus underpin stability. Overall, MIT remains a steady, income-generating REIT balancing caution with growth. If you found this helpful, give a thumbs up, comment, subscribe for more REIT insights.